All right, today we'll look at some ETFs. Those are like a stock that has a basket or a number of stocks inside of them and their charts. So we'll start with this one, JPST. This is kind of like the money market or kind of CD kind of ETF. It holds treasuries, short-term treasuries. And as you can see from the chart, let's explain the chart real fast. These candles, the red and green candles, those are weekly moves in the price. And on the right-hand side, we have the price. And at the bottom, we have the years. So you can see that this has been around for about 6-7 years. And JPST, the treasuries, the price basically stays almost the same. It only varies by 1%. Now, this is without dividends. If we hit this little ADJ button down here to include the dividends, and you can see that that's what the total return is over the last 6-7 years. So they make right now they're paying about 4%, 4.5%. Actually, let me see. They're paying 4.98% today. And as the Fed lowers rates, that'll be reflected in this chart. So they'll pay less as the Fed lowers rates. But here's JPST, very safe. Just holds short-term treasuries. This treasury is like a year or less. This is kind of a good place to replicate something like a CD or a money market account. Next, we'll look at many people's favorites. This is JEPI, JEPI. This is the one that has low volatile stocks from the S&P 500, so safer stocks. And they sell covered calls on it, which means you're selling some of your potential upside each month for guaranteed payment in cash. That's the option. Right now it's paying 7.3%. And this is how the chart looks over the last, started in 2020, so about 4 years, 4.5 years. And this is with dividends. If you take out the dividends, you can see the price doesn't move a whole lot. But we want to look at total return. So that's the price of the ETF itself and its dividends. It's more accurate. And so it's pretty, it's not very volatile. It does what it's supposed to do. It's supposed to be pretty conservative, pay out a regular monthly dividend, and it's supposed to protect you on the downside. So remember that 2022, that's in here, was the bear market. S&P went down 20%, and JEPI, the year started here, 2022, the year ended here, 2023, basically broke even. So it also accomplished that goal of protecting you during bear markets. And that's including the dividends. So we can hit this little plus button up here and compare it to a symbol, which is useful. So we're going to compare it to the SPY. SPY is the S&P 500. So the candles, once again, is going to be the ETF like JEPI. And the red lines, that's going to be the S&P 500. So you can see that over time, the S&P 500 has outperformed JEPI. Almost, S&P 500 is really good, outperforms almost everything. So the reason to own JEPI would be for that 7% dividend, which is paid out monthly, and to protect you during bear markets. It's more conservative. So if we zoom in just on the bear market year from 2022, there we go, that's pretty close. You can see the S&P 500 went down 22%. Let's try to get the whole year in here. There we go, that should be pretty close. So in the whole year, the S&P 500 went down 11%, but at one point it was down like 18-20%. So here in this time frame, we have the S&P 500 was down 17%, but JEPI during that same time frame basically broke even. It was up just less than 1%. So it did a good job in the bear market of protecting your money, paying out that dividend, and keeping you from this bear market. But in a bull market, we can see like since 2023, JEPI still went up, In the last 2 years, it's gone up 22%, but it didn't perform as well as the SPY, but it's really not supposed to. SPY's up 55% in 2 years. Remarkable. And JEPI's up 22%. So JEPI's the safe, conservative ETF that exposes you to the same kind of moves as the overall market, but it pays a guaranteed dividend and it protects you from bear markets like we had in 2022. Next, we have iSpy. So this is exactly the same as S&P 500, except it pays out. Right now, it's paying the last 12 months. It's paid a 10% dividend. They also pay monthly, and you can see it hasn't been out very long. None of the covered calls have been out very long because it's not a new technology. Traders have been doing covered calls for decades, but only recently has that been made into an ETF. So, anyways, here's iSpy. You can see once again the candles are the ETF we're talking about, iSpy. The red line is the S&P 500 itself. So it tracks pretty closely. Over the last year, iSpy is up 23%, and the S&P 500 SPY is up 26%. So tracks the SPY pretty well, pays out 10% dividend per year. This chart is including the dividends. And to the upside, it'll just track just below, but it'll help you in a bear market. Next, we have PBDC. This is a business development company. It's actually an ETF of about 30 to 50 business development companies. Business development companies, they loan out money to businesses. And they get to borrow at 2%, and they loan it to the businesses at 10, 12%. And that's how they make their money. Right now, PBDC over the past 12 months has paid out 9.5% dividend. And here's the chart. As you can see, it's basically tracked the S&P 500. Since October of 2022, it's up 68%, and the SPY is up 71%. So it's pretty much just like the SPY. It's performed just like the SPY, but has a different business model. It's good I like it for some kind of diversification. Next, we have SVOL. This one's kind of tricky or hard to explain, but SVOL, first of all, it pays out 16.7% dividend. That's paid out monthly. SVOL basically shorts long-term volatility and buys short-term volatility, and there's money to be made there, as you can see by the chart. Volatility is when the market goes up very rapidly or down very rapidly. And so you can see since it came out in 2021, it's performed almost exactly as well as the SPY. In that time period, it's up 43%. The SPY is up 50% this time period. You could tell by the chart here that it's less volatile than the SPY. The SPY S&P 500 has a lot more zigs and zags, ups and downs. The SVOL has less dramatic up and downs, as you can see. But its overall performance is about the same. If we look at the bear market of 2022 again, like we did with JEPI, you can see that including the dividends, the SPY went down about 15% during this time period, the red line. And SVOL only went down 0.2%. So basically broke even for the year. So it's also a good stock for avoiding pain during bear markets. And as you can see with the most recent time frame, it's also really good in the bull markets. If we start at 2023, SPY's at 56%, SVOL's up 43%. And until recently, it was outperforming the SPY, the S&P 500. So SVOL, another diversification tool that has good performance, pays out a monthly dividend with a total yearly dividend of 16.7%. Next, let's look at the SPY itself, the SPY. That mimics the S&P 500, and it's pretty hard to beat. It's the most popular ETF in the world, and the way it works is it takes the 500 biggest companies in the United States, and it changes its allocation every quarter, and it changes who it's in it every year. So that keeps it kind of up to date. If some stocks are doing really well, then they'll add more of that stock. Some stocks are doing poorly, they'll own less of that stock. So it kind of keeps you up to date on who's the winners and who the losers are. It kind of takes care of itself, basically, which is real nice. It's basically the benchmark of the whole market. And as you can see, it has a long history. And it goes up over time. So we had the bear market was down about 20% in 2022. So it does have some volatility to it. But with a long enough time horizon, it does go up over time. This makes up the core of many people's portfolios, including my own. And it's a good ETF to use to track the market. It pays a 1% dividend, 1.2% per year, and that's paid quarterly. Yeah, that's the S&P 500. Basically a way for you to own the market in one ETF. Next, as I mentioned, not many things outperform the S&P 500. It's pretty difficult to do that. But one who has consistently outperformed the S&P 500 is the NASDAQ 100, QQQ. So this is more tech stocks. There's no financials in the NASDAQ 100, the QQQ. And there are 100 stocks. S&P 500 is 500 stocks. As you look over time, if we go back to 25 years or so, the Qs have outperformed the SPY. If we look since about 2000, the Qs are up 1,000%. The S&P 500 up 600%. So the Qs are more risk, and if we continue bull markets, more reward. And especially in the past 10 years, if we start from about 10 years ago here on the left, 2015, it's even more dramatically outperformed the S&P 500. Over the last 10 years, S&P 500 is up 265%, so that's more than a triple. But the Qs, the NASDAQ, is up 500%, which is like a 6x. And as you expect, with more risk or more reward, if you look at the bear market of 22, it went down more than the S&P 500. At one point, it was down like 25%, even 30 at its lows. So more risk, more reward. It's one of the few stocks over time, few ETFs that have outperformed the SPY. All right. Next, we got one that I like quite a bit, XLV. XLV is all healthcare. It's the biggest, about 100 healthcare companies in the United States. I like it because, if you scroll back to its long history, it almost performs the same as a SPY. As you see in this like 12, 13-year history, the XLV, the healthcare ETF, is up 430%, and the SPY is up 495%. And until recently, I actually outperformed the S&P 500. It has one more benefit to it. So if we zoom in on that bear market again, healthcare is considered like a consumer staple, a necessity. People don't stop buying healthcare generally. And so if we zoom into the bear market, you can see the SPY, the red line again, dipped quite a bit. It was down 24% at one time. But the lowest the XLV healthcare got was down about 12%. So it's more conservative, less volatile, And over time, it performs almost as well as the S&P 500. Lately, last 2 years, since we have this AI tech boom, that's when this kind of divergence has happened, where the SPY, which has lots of tech in it, has really taken off, especially compared to healthcare. Next. So, as I've shown, these ETFs, you could almost think of any theme or any industry, and somebody's made an ETF for it. ETF is a basket of stocks. So we looked at healthcare right now, and here's another one I like, PPA. That is aerospace and defense. So think Boeing, Northrop Grumman, Lockheed Martin. I think it's about 50 to 100 of these top stocks. And if you look at its history, it has a long history as well. It's over the last 10 years, it's done better than the S&P 500. And if we check that bear market of 22 to see how it handles a downturn, trying to get these dates lined up. The government probably is not going to stop spending on missiles and guns and bullets during a bear market. And so as you can see, SPY was down 15-20% during the bear market of 2022. And PPA, the defense ETF, had volatility, but the lowest it got was minus 9%. And it actually made money during the bear market, plus 11% at the end. So I like PPA quite a bit. Seems stable and also long term performs pretty well. That's PPA. Think of it as defense, aerospace and defense. Almost done here. So as I said, you could do industries, healthcare, defense, technology. Another one that you own that I got for you is chat. Doesn't have a long history. This is AI ETF. And as you can see, over the last 2 years, as you'd probably expect with the AI boom, it's outperformed the S&P 500. Since this was started in May 2023, SPY was up 44%, chat was up 61%. And I don't think they pay much of a dividend. No dividend. But so there's a high growth, high risk, high reward ETF. 3 more. Next we have TLT. This is a very safe one. This is, well, supposed to be anyways. This is long-term treasuries. It holds lots of long-term treasuries. And it does not outperform the SPY. SPY does quite a bit better, even if you look at its long history. If you look at like 15 years, you see that it was doing well for a while. And then since the Fed started raising rates, it's pretty much crashed since 2022. It pays a 3.8% dividend. And so if you're a contrarian, you think that things will get back to normal, then this is a pretty good one to pick up. You get about a 4% dividends, 20-year treasuries. And so if you're interested in owning treasuries, that's TLT, long-term treasuries. I think it's 20 to 30-year U.S. treasuries. So you can see from the chart, it kind of tracked the S&P 500 for a while until about 2020. It's crashed quite a bit, like 50% or so. So it's a good contrarian play. It's good for diversification. You'll get some slow growth out of it, but it's not too exciting, but it might make up a part of someone's portfolio. Then we got 2 more. Like I said, they have an ETF for just about everything. They do have an ETF for gold, GLD. And here's the gold's chart. If you look at about the past 2 years, it's performed pretty well. It's tracked basically almost the same as the S&P 500. It's up about 30% in the last 2 years or so. It had a long period of basically where it did nothing. So if you look here, we zoom out pretty far. In 2011, over here, we had this top here. And then we just went down and sideways for almost a whole 14, 15 years. And we just started to break out of that sideways to lower pattern, basically. So gold did nothing for about 10, 15 years. And the past year or two, it started to finally move up again. We go back pretty far. So here's a chart of gold. It did pretty well in the early 2000s, up to 2011, and then it kind of puttered out for about 10 years, 15 years. So it doesn't outperform the S&P 500, but it does have lower correlation. So as you can see here, gold did kind of different things than the S&P 500 during this decade here. So people like a little bit of gold in their portfolio for diversification and low correlation. You still make money on it. You may not make as much as the S&P 500, but you could have times when the S&P 500 is going down and gold is going up. And last, since there's a Bitcoin for everything, an ETF for everything, there's new ETFs for Bitcoin. Here's FBTC. This is by Fidelity. It only came out about a year ago. But here's the 1 year chart. Here's S&P 500 for a year. It's up 25%, which is really good. And Bitcoin is up 100% over the last year. So if you want to dabble in Bitcoin, you could buy that in an ETF, FBTC. And as you know, it has some really good years and some really bad years. So that's the ETF overview with charts. If you think of an industry or a theme, there's probably a ETF for it. If you want like energy, XLE is the energy ETF. And so that has companies like Chevron and ExxonMobil, Oxy in it. And you could tell by this chart here, especially the last 10, 15 years, it hasn't done much. Since 2009, it's up 200%, whereas the S&P 500 is up 900%. So energy sometimes sounds good to me, but if you look at its performance, it hasn't really done a whole lot in the last 15 years. It does pay a nice dividend. It pays 3.5% dividend paid quarterly. All right. Hope that was informative and helpful. Give you an overview of some ETF options that are out there. All right.